Before we get into this, every number in this video comes from a public source. Everyone is talking about bubbles right now. AI bubble, housing bubble, commercial real estate bubble, bond bubble. There is a cottage industry of financial commentary dedicated to identifying the next asset class that is going to collapse and take someone's portfolio with it. And most of that commentary is pointed at the exciting stuff, the technology companies, the speculative assets, the things that feel like they could be overvalued because they're new and fast and nobody fully understands them. Nobody is pointing at the burger place. I'm going to argue today that the fast casual restaurant sector is trading at valuations that have no rational basis in the fundamentals of the underlying business. That Shake Shack, Wingstop, Kava, and the rest are carrying price to earnings ratios that exceed many AI companies. And the reason nobody is calling it a bubble is the same reason it is one. Because food feels safe, and safe feeling assets don't generate bubble discourse even when the numbers they say they should. For the argument, the tool. Because this video is going to live or die on one number, and I want to make sure that we are all speaking the same language. The price to earnings ratio, P to E ratio, is the most fundamental valuation metric in equity investing. It tells you how much investors are paying for every dollar of company profit. If a company earns $1 a share and the stock trades at $20 a share, the price to earnings ratio is 20. You are paying $20 for $1 of earnings. The S&P's 500 historical average price to earnings ratio is approximately 16 times. That is the baseline. That is what the broad market has historically asked investors to pay for a dollar of corporate earnings. A high price to earnings ratio, anything significantly above that baseline, means one of two things. Either the company is expected to grow its earnings very rapidly, making the current multiple look cheap in retrospective as profits catch up to the price, or that the company is overvalued and investors are paying more than the fundamentals justify. The question always is, which one is it? Is the high multiple a bet on future growth, or is it a delusion about a company that will never earn enough to justify what people are paying for it today? That question is what the video is about, and the answer for several of the most prominent fast casual brands is not encouraging. Let's look at the numbers. Shake Shack price to earnings ratio as of February 2026, 80.87 times, according to public filing data. 80 times earnings for a burger company. Wingstop, its 10-year average price to earnings ratio is 92.43 times. Its peak in September 21 was 183 times earnings. $183 of price for every $1 of profit from a chicken wing franchise. Chipotle, trading at approximately 45 to 50 times earnings, despite comparable sales declining 1.7% in fiscal year 2025. Now, let us look at what they're being compared to. The McDonald's price to earnings ratio is approximately 26 times. Domino's also 26 times. Shake Shack and Wingstop are trading at 3 to 4 times the multiple of McDonald's. The company, with 40,000 locations on every continent, generating tens of billions of annual revenue, with decades of demonstrated earnings power, investors are paying 26 times its earnings. The company, with 659 locations, a 3.2% net margin, and flat average weekly sales, investors are paying 80 times its earnings. Sit with that number. The multiple might be justifiable if the earnings were growing fast enough to make the current price look cheap in 3 years. So let us look at what the earnings are actually doing. Shake Shack, fourth quarter 2025 from their SEC 8K filing, a net income of $13 million on $401 million in revenue. That is a margin that I previously said 3.2%. Their average sales, like I said before, flat. It is not declining. It is also not growing. It is flat. Chipotle's full year 2025, their Restaurant sales were down 1.7%, comparable restaurant sales. Their operating margin compressed from 16.9% to 16.2%. Revenue growth slowing from 12.57% in 2024 to 5.41% in 2025. Wingstop fourth quarter 2025 earnings per diluted share $1 versus 95 cents the prior year. That is a 5% earnings growth rate. This you are trading at 92 times average earnings for a 5% earnings growth rate. At that growth rate, it would take approximately 18 years, nearly 2 decades, somebody could go and graduate high school and get a college loan for Wingstop's earnings to reach the level that would justify today's multiple at a normal valuation. That is assuming no competition, no margin compression, no consumer behavior shifts, no macroeconomic downturns, especially for a meat that is as volatile as chicken wings, no macroeconomic downturns for 18 consecutive years. The earnings are not growing fast enough to justify the multiple. It's not even close. The multiple is a narrative, and the narrative is clearly, much like Tesla, not in the filings. Every overloaded asset has a story. Every overvalued asset has a story. The story for fast casual goes like this. These brands are still in early innings of their expansion. Shake Shack is the next Chipotle. Wingstop is also the next Chipotle. The current earnings are not the point. The point is that the unit economics work and there are thousands of locations yet to be opened. Shake Shack's analysis consensus growth thesis requires them to reach approximately 1,500 plus locations. They currently have 659. That means the price you are paying today is pricing in 841 locations that do not exist yet. Every one of those locations needs to open, ramp up, and perform at current unit economics in markets that may be less favorable than their existing footprints. Come on, guys, there's been a supply squeeze of beef recently, with real estate and labor costs that have risen substantially ever since they opened their best performing locations. And here's the problem with the next Chipotle thesis. Chipotle's comparable sales are declining 1.7%. Chipotle's margins are also compressing. I said again. Chipotle, the company that Shake Shack and Kava and all them other bowl motherfuckers that want to be the next Chipotle, is struggling with the exact growth challenges that Shake Shack hasn't even accounted yet because they're still much smaller. The destination you're trying to reach is already showing signs of structural difficulty, and you're paying 80 times earnings from the journey. Here's the structural problem that makes the growth thesis even harder to execute than the unit economics suggest. Fast casual is getting squeezed simultaneously from two directions. From below, it's McDonald's and the broader quick service segments. They are actively recovering market share from fast casual. According to Technomic 2025 data, quick service is gaining 8.1% of dining occasions that previously went to fast casual restaurants. The consumer who is trading up from McDonald's to Shake Shack is trading back down because Shake Shack raised prices to protect margins, and at a certain price point, McDonald's starts looking reasonable again. From above, it's casual dining. Chili's, Texas Roadhouse is eating fast casual's lunch. Haha, I made an eating joke. From the other direction. They are offering a sit-down experience, a full bar, better value per dollar on the check, at a price point that is increasingly close to what fast casual charges. The consumer who wants to feel like they are treating themselves is choosing the place with tablecloths over the place with a counter and a number on a stick. According to Black Box Intelligence's 2025 consumer data, fast casual spending growth turned negative across every income group. High earners are eating at Texas Roadhouse. Lower earners are going back to McDonald's. The middle, which is where fast casual lives, is hollowing out because if you're going to be as expensive as Texas Roadhouse, then suddenly McDonald's and Texas Roadhouse gain their value propositions again. We've seen this before, the expensive middle being compressed from both directions. We called it when it happened to AAA gaming. Same shit, different butts. Or more academically, same structure, different industry. And here's the thing about bubble discourse, it follows attention. And attention follows excitement. The AI bubble conversation exists because AI is exciting. Crypto had bubble discourse because crypto was exciting and volatile and generated headlines. Even the housing bubble generated enormous discourse because housing is something everyone has a stake in. Nobody gets excited about a chicken wing franchise. Nobody generates viral content about Wingstop's price to earnings multiple. The financial media is not going to run a segment called Is Wingstop Overvalued because the audience for that segment is 11 people and 3 of them are short sellers. But boring assets can be just as overvalued as exciting ones. They're just overvalued quietly. And quiet overvaluation is more dangerous than loud overvaluation because loud overvaluation gets corrected by the attention it draws. Quiet overvaluation just sits there, pricing in a future that may never arrive until one bad earnings call reminds the market what the multiple was actually buying. The people always eat thesis is the intellectual foundation of the fast casual premium valuation. It is a defensive sector argument. Food is recession resistant. Restaurants are a necessity. People always need to eat. But people don't need to eat at Shake Shack. People need to eat. Where they eat is extraordinarily price sensitive, and brand loyalties in the restaurant space is significantly weaker than investors appear to believe when they price those stocks. The safety is a feeling, and the earnings are a number, and the number doesn't support the feeling. The dot-com bubble is the canonical reference point for irrational exuberance in financial markets. Companies with zero revenue trading at infinite multiples. Pets.com, Webvan, assets priced entirely on narrative with no earnings foundations whatsoever. Fast casual is not that. Fast casual has real earnings and real locations and real revenue. The comparison isn't to pure.com insanity. The comparison is to the .com companies that had real businesses but whose multiples reflected a story about future dominance that the underlying unit economics couldn't ultimately support. Shake Shack's narrative is the next Chipotle. Chipotle, during its high growth phase from 2011 to 2015, traded at 50 times plus earnings. That was arguably justified. Chipotle was growing comparable sales at double digits, expanding rapidly, and demonstrating that the unit economics held at scale. Chipotle's comparable sales are now declining. The story has reached its limits. The multiple contracted. That is the correct outcome. Shake Shack is being priced at the beginning of the Chipotle story, while Chipotle is demonstrating what the end of the Chipotle story looks like. The narrative is not keeping up with the data. That gap between narrative and data is where bubbles live. Since we're making comparisons, let's make the one that's most damning. Nvidia's price to earnings ratio was ranged between approximately 50 and 65 times. That sounds expensive, and it was expensive. But Nvidia's earnings were growing at over 100% annually. When your earnings double, every year the current multiple starts looking very cheap very quickly because the denominator is expanding faster than the price. Shake Shack is at 80 times earnings, more than Nvidia. Earnings growth at single digits. The earnings are growing at single digits. Their net margin is 3.2%. Wingstop is a 92 times average earnings over 10 years. Earnings are growing 5% annually from a chicken wing franchise business. The AI hyperscalers everyone is worried about are trading at high multiples relative to current earnings and justified by explosive earnings growth. And the fact of the matter is that some companies like Microsoft are actually trading at a lower price to earnings ratio than they were before the AI craze. The fast casual restaurants nobody are worried about are trading at comparable or higher multiples relative to current earnings and justified by a growth story that the actual financial returns are not confirming. You are paying AI companies prices for restaurant company fundamentals. And nobody is writing the article about it because restaurants are boring and AI is exciting. Boring doesn't necessarily mean safe, it just means under-examined. And under-examined is where bubbles hide. So, essentially, these are software companies on restaurant company fundamentals. The price is pricing in a future that the earnings are currently not demonstrating any capacity to deliver. The story is doing the work that the numbers should be doing. Nobody is calling it a bubble because it sells burgers. That's exactly what makes it a bubble. The SEC filings are public. The macro trends data is free. The math is not complicated. The only thing between you and this conclusion is whether you thought to look. And I did. Hopefully. Uh, like, comment, subscribe. If you went through this video, I'm gonna need you to give me a basketball, football, bowling ball in that order so I can get more engagement. And then also, if you do that, I'll answer any question you have that you put onto it in the comments below. So anyway, guys, see you. Peace.